Double top and double bottom are very traditional pattern in day trading. Sometimes they will lead to good trading opportunities, though not all the time. So in this video, I'm going to show you how to identify the double top and double bottom opportunities and trade accordingly. So let's get started. I will cover the following topics. Number 1, double top and double bottom basics. Here I will use M and W to replace double top and double bottom. Number 2, how to use double top and double bottom in day trading. Basically, there are two setups. The first one is the reversal setup, and the second one is continuation setup. And in the end, I'm going to show you some trading examples. What is double top and double bottom? Basically, in the first look, you should be able to identify it is either M or W. Here, you should be able to see clearly there are two pushes up in the M and two pushes down in W. There are a few things about the double top and double bottom. Basically, as we know, double top and double bottom are reversal patterns. Here, the reversal means the reversal of the first leg. Let's take this W for example. So for M, it's the same logic. We have the first leg down here, and then it's a downtrend. And then the last leg is reversing the first leg. So here, it's only reversing the first leg. It depends on where this W is. It could be reversing of the whole trend, or it could be the continuation of the whole trend. However, the reversal here refers only the first leg. Second, for the second push down here, whether it is making a lower low or a higher low, it really doesn't matter that much as long as the two pushes are relatively on the same level. So even though the higher low will have a higher probability of the reversing of the trend. The third thing is about the probability. So basically in the old days, this reversal pattern had a very high probability of winning trades, especially for the long-term trending. So a lot of traders made a lot of money by just trading the reversal pattern because this pattern normally leads to very big trend. However, these days, due to the increased trading volume, especially with the computer programs, the probability is lower over time. It is the same situation for the candlestick patterns. In the old days, you don't have to pay much attention about the whole setup and the whole chart. You can only trade the candlestick pattern and have a very good winning ratio. However, these days, the candlestick patterns don't work very well. Now let's move on to the second part of the video. So it is about the double top and double bottom in day trading. There are two setups. The first one is the reversal setup. So basically, the reversal should be the pattern for the whole day. That means if you take a look at your whole screen for the whole day, you should be able to identify it is a double top or double bottom pattern. Second, it's the continuation setup. So basically here, it doesn't really matter whether it is a trending day or range day or reversal day. This double top and double bottom is only part of the pattern for the day, which means it serves as the pullback for the whole trend. Now let's take a look at this chart for the reversal pattern. First, we have a downtrend here. And then we have a low, high, and a low. And then what we are waiting is for the market to break the previous high. Here's the previous high. And then the market breaks a little bit. Then we move on to the next step. This step is very, very important, that we need to observe the price action after the break. That is because previously we have a downtrend here. We have a high, and then it breaks a little bit. However, it is still in the short buyers. So a lot of traders are still selling here. So if the market continues here to the downward, that means this is the double top for the continuation pattern. That is why this step is very important. And also you can see that here we have a bear bar. So a lot of traders will put their sell order below this bear bar. And this is another bear bar. You can see that the market actually goes down below this bear bar. That is because there are sellers who's gonna short also to the downtrend. And then what we can see is that the price action shows us there's a pullback of the bear bar, and then it reversed by two bull bars here, and then another bear bar by two bull bars, another bear bar. So that means the bear is losing its steam, and then the bulls are getting their strength. And another thing is, just based on this part, you can see that the market is making higher highs. This is high, this is higher high, and another higher high. Also, at the same time, it is making lower low, higher lows. So this is the low, this is a higher low, and this is another higher low. This is also a confirmation of the uptrend or buying pressure. Another thing you should notice is here, this bull bar. Basically, this bull bar is a little bit higher than this previous high. This is another way for you to confirm it is an uptrend. So there also could be other indicators that you can use for the confirmation to the upward. For example, if you have a EMA drawing on the chart here, you should be able to see that around this area, most of the time, the bars are above the EMA. So that is another confirmation for the uptrend. If that's the case, you're having upward buyers right now, then you need to wait for a very good signal bar to trade upward. So here comes a very good bull bar, because this bull bar has 60% of the body account for the whole candlestick. So you should enter upon the finish of this bull bar, either at the top or upon the close. If the 5-minute chart is too choppy and not clear to you, so you can move upward to the higher time frame. So here's the 10-minute chart. We can see the price action around this area. So here, the pullback, here is a bear bar here. However, the tail at the bottom is very big. That means the support. The next one is also a bear bar with a very big tail at the top. However, the body is very, very small. And then even the close is still within the previous bull bar here. So these two bear bars didn't reverse much. That means the buying pressure. And then the next bar here, it breaks the previous bear bar top. That's the strength. So upon finish of this good bull bar, which accounts 60% of the whole candlestick of the body, then you need to enter the market. For the candlesticks, I have another video in my channel that you can watch. So in that video, you will learn how to use the candlesticks to tell the strength of the market and how to use the candlesticks for the signal bars. Right after you enter the market, you should put your protective stop there. So there are a few options. The first option is you put your stop at the bottom of the pullback. So basically, here is your pullback bottom, so you put at the bottom here. The drawback for this is that the market could really go down again to test the pullback, and then it's possible that you get a stop. The second option is you put at the bottom of the whole pattern. So here, this one is the lower low based on these two pushes. So you put at the bottom of this pullback. The good thing is that you give a very good breathing room for the market to develop. However, if the market really comes down here, you're going to have a very large stop. However, most of the time, before the market goes down, a lot of traders will already close their position, because while the market is going down, that means this W shape doesn't work anymore. It's not valid, so you're out of the market. The third option is you can put in between this pullback bottom and the bottom of the pattern in between. So one option is you use the bottom of a trend bar. So this bull bar is very big, and then it serves as a trend bar. So you can put at the bottom of this trend bar. Then you give enough room for the market to develop, and then at the same time, the risk is not that much comparing to the bottom of the pattern. And then right after the market takes off, you can see that the market goes your way to the upward. Then you need to move your stop, protective stop, to your actual stop, which should be the bottom of the pullback. For the profit target, there are also a few options. The first option is N times your actual risk. So basically, here is your actual stop. You measure your risk from the actual stop until the entry. So if you enter at the top of this bull bar, so here's your risk. This is 1 time of your risk. And then if you measure up, you can see that this is the 1 time of your risk if you take the profit target here, and then this is the 2 times your risk. You can see that in this example, it reaches the 2 times of your risk. However, you can also use a fixed amount of profit. For example, if you are trading the currencies, you can take 10 pips. Or if you're trading crude oil, you can take 10 cents or 20 cents. If you're trading ESE mini S&P 500, that's 2 points or 3 points. Or ETH, you can take $200 or $300. It really depends on whether you can have a constant profit based on your calculation of the historical chart. The second option is to use the previous major or minor high or lows. So take this for example. Here we have a level here. This is the previous high here. The reason is because here you can see the market goes down here. So this level serves as the support. And then after it goes down below this level, it serves as the resistance again. So this level is very important support and resistance levels. So it is reasonable for you to use as a profit target. Another level is here. You can see that here is a minor high here, and then here's a low here. That means this is the support, and here serves as the resistance. The third option here is the top here. This is the previous high for the same day. It is also very reasonable for you to have your profit target here. However, in the end, you should select the one that is most reasonable to you and which is the easy to reach for you to take the profit. The third option is the measured move. So basically, most of the time the market moves by waves or at the Elliott waves. So there might be 1, 2, 3 legs here, and then each leg most of the time will move roughly the same distance. So if that's the case, we can do the measured move for the first leg from the bottom of the start of the first leg until the last bull bar here at the top. So this is the measured move. And then we measure the same distance from the pullback for each pullback basically. So here's the first pullback, and then we measure up by the same distance. So here's the profit target. And then there's another pullback. We can do the same measure again. So from the bottom of the pullback and then measure up. So you can see that if we use the measure move for this second leg and the third leg, they meet the profit target. As we can see that there are multiple legs in the trend here. So if you want to take more profit, you can choose to swing rather than scalp, or use scalp and swing at the same time. However, one thing for beginner to notice is that for the swing, you really need to survive this pullback. For this example, your entry is at the top of this bar. However, you can see the pullback comes down too far. It's almost there for your entry level. So it's very hard for beginners to hold for that long, especially for so many bars here. And a very good option for you is to take part of your position off along the trend. Here's an example. In case you have enough position, what you can do is that, so you can take half of your position off by 1 time of your risk. This is because when you take half off, even if for the rest of the half, the market comes down to hit your stop at the bottom of the pullback, you're gonna break even. So you're not losing anything. This is very important for the beginner traders. And then you can take another 1/4 of your position at 2 times of your risk. Basically, from the previous calculation, 2 times of your risk is at the top of this tail of this bull bar. And then you can choose to swing the rest of your 1/4 of your position to the end of the trend. So if you take your profit for this 3/4 of your position, you don't feel any pressure to swing the rest of the position. And then you can see that the market goes for the third leg, you can take more profit. Now let's move on to the continuation pattern. So for the continuation pattern, it normally happens at the start of the trend. It's different from the reversal pattern, which happens at the end of the trend. So for this example, we have a consolidation and then the market breaks downward. We have the pullback here and then another push here. So these 2 pushes forms the double top. And then this whole double top serves as the pullback. Then we want to do is to wait for the signal bar to enter. So here is the bear bar here. We can enter here, though this signal bar is not very strong. Or we can choose for another signal bear bar here, 2 bars we can enter at the bottom of here. Or even we can enter at the low of this pullback here. So no matter which way, it also works. One thing to notice for this continuation pattern is that basically here there's a downtrend. And then here's the first pullback. A lot of traders will already enter the market in this first pullback. So you don't have to wait for the second pullback because you never know whether there's a second pullback. And then this second pullback can serve as a good opportunity in case you didn't enter the market here because this bar is not very strong. And then when the market goes down, you miss the opportunity. So when it pulls back again, so you can re-enter the market. Or if you enter the market for the first time, and then you can add to your position at a second pullback here. So whichever way that works. Another thing to notice is that the second pullback is higher than the first pullback. So in case you choose to enter the market at the first pullback and then you put your stop at the top of this pullback here, you're gonna get stop out. That is why that it's better that you give a little bit more room for the market to breathe. Let's say you put the stop at the top of this bear bar, so you won't get stopped by this pullback. We can see the double top or double bottom can serve as the pullback for the continuation of the trend. However, the three pushes can also lead to reversal or continuation trend. So the same chart here, we can see that after the market goes down, we have the first push up, second push up, and third push up, and then the trend continues. Again here, so there's first push up, second push up, and then third push up, and then market continues. So this is something that on top of the double top and double bottom, three pushes can also serve as the continuation or reversal pattern. I will have another video to talk about this later. The same situation for the protective stop. So there are a few options here. The first one is to put at the top of the pullback here. That means it is very tight. It could get stopped out if the market goes back to test this level. The second is at the top of the pattern here. You give more room but more risk. And then third is to in the middle that you can put at the top of a big trend bar here. This makes more sense. For the profit targets, it's the same thing. So the first option is end time of your risk. If we enter at the bottom of this low here, then we measure from the top of the pullback. Here is your actual risk. If we measure down, we can see that this is the 1 time of your risk and this is the 2 time of your risk. We can see that the market bounced back here because some traders will take profit at here. And then here you can see it bounce back again. That means some other traders will take 2 times the risk. If we enter at the bottom of this bear bar, we can see that this is 1 time risk. And then your profit target is here and also here. That you can see the market bounce back here. That means other traders taking the profit at the same time. We can also use measure move. So the same thing, we measure from the top of the first bear bar here until the bottom of the last bear bar for the first leg. And then we measure down from the pullback. So here's your profit target for the second leg. And then if we assume that this is another pullback for the third leg, we can measure again here. So you can see that the market just go down to touch the measure move. That means other traders are using the same measure move to take the profit. And also you can use the high lows from the previous day or from the same day previous chart, or you can use other support or resistance levels. It works the same. Now let's move on to the last part of the video. Let me show you some examples. Let's take this chart for example. First, we want to do some preparation for the trading. We want to draw all the important levels. This level is the previous day's high. And then we also have a high of the same day. Then we can have some pivot levels, such as the R1 and the PP. Then we see the market goes down here and then makes a high here. And then it goes down and pulls back. So when we see this bull bar, it is breaking the previous high. So it is possible it is a double bottom, reversal of the previous downtrend. And then for this bull bar, we can see that it is a very good bull trend bar. It is the largest bar in the chart because it is larger than all the bars on the left. So basically for this bull trend bar, that means a high probability of the uptrend. So you can also see the same thing in my candlestick videos. And then what you can do is that you can choose to enter at the top of this bull trend bar to capture the trend early as possible. However, you can also wait for the pullback. the market moves up by another good bull bar, and this bull bar breaks the previous high here, this increases the probability of uptrend, and then right now you want to only trade upward. What you want to do is to wait for a pullback. So basically here comes another doji bear bar. So this doji bear bar can serve as the pullback, especially for the very good breakout pattern here. And then you want to enter at the top of this doji bull bar. That is because of the strong uptrend here. Or you can wait for another good signal bar for the next bull bar here. It is a very good signal bar, and then you can enter at the top of this bull bar. However, the market didn't go right away beyond the top of this bull bar. Then you can choose to wait for another good signal bar. When the market comes down for another 2 bear bar here, you can see that these 2 bear bar didn't reverse even the previous bull bar. So that means the pressure for the downward is not very strong. And then when you see this small bull bar, even though it is small, it can still serve as a very good signal bar. So basically, for the very strong trend, the signal bar doesn't matter that much. The requirement for them is not very much. And then you can choose to enter at the top of this good signal bull bar. If you didn't enter at this pullback and this signal bar, you can see there's another very good bull bar here. However, the thing about this bull bar is that it is too close to the previous high and the previous day's high. So if you choose to enter here, it's possible that the market will pull back right away. So you can see the market respect this high a little bit and also respect this previous day's high. So that means your profit target might not be reached right away. Right after the market goes to your way, you need to put your stop at the bottom of this pullback here and then hold very tight, because later on you can see the market comes down to test your stop, but it failed. It didn't reach your stop. So this is very important for you to understand that if the market really goes down to stop you out, you really need to take the loss. In terms of the profit target, let's take a look at this reversal pattern. We have a downtrend here. However, the upward reversal is very strong with 2 good signal bull bar here. That means the trend will go up very far. So that means you can see that for each of the level, for the R1, the previous high, they also reached. And even for the measure move here, it also reached. So if you see that this very strong reversal trend, you want to put your profit target as far as possible to take more profit. Now let's take a look at a continuation pattern. So the same thing, first we want to do some preparation. Here's the previous day's low. And then we also have a low of the same day. And then we have a trend line here. So basically, when you see the trend line break here, you can wait for the pullback, which is this bull bar. And then this is the signal bar. You can trade down here already. However, you can also wait for the market to go down to break the previous low here, this level, and then wait for the pullback. So if that's the case, you're going to enter the market upon seeing this bear bar. However, the market goes back here to be beyond this pullback, and then it has this bear bar. You can also enter at the bottom of this bear bar, because right now it seems that there's a double top here. And then you can see the market goes down, however it goes back up. So it makes another higher high. So basically this high and also this high can also serve as the double top. So you can enter the market when you see the pullback and then goes down. Basically, after you enter the market in this bear bar, you want to put your stop at the previous pullback here. This is a very reasonable one. So you won't be getting out of the market. Also, you can put your stop at the top of the trend line, because if you are trading the trend line break, this is also reasonable stop level. And then you can see the market moves back downward again, and then you can use this bear bar or even this bear bar to enter the market. And also you can use this low here to enter the market as well. So in case you enter at the bottom of this bull bar here, that means you want to measure the profit target by the actual risk based on this. So you can see that this is the 2 times of your risk here. it is lower than the previous day's low. However, the market goes down to the previous low and then it pulls back. So that means the previous day's low is a very reasonable level for you to take the profit rather than the 2 times of your risk, because when the market pulls back, it goes back up too far that it's going to test your entry level here. So it's very hard to hold your position until this moment. That also means that even the previous day's low, it's possible that the market doesn't reach it before it pulls back. So it's best to take the profit before it reaches the previous day's low. Let's take a look at the whole chart. So basically you can tell the market is not very strong. That is because first, this is the first leg here. And then in between, there's a pullback with a bull bar. So for consecutive bear bars, that means strong market. But if there's a pullback with a bull bar, that means the market is not strong. And also another thing for you to tell is that the pullback here is a double top. Double top normally means the market is not strong if it is a continuation pattern. And then it leads to the second leg down here. You can see that in between there also pullback with the bull bar and bull bar here. That also indicates the market is not strong. And then the market goes up again here. We can see there's another 2 top here. This is also a double top. However, the good thing for this double top is that the second top here is a lower high. That means it increases the probability of the market going down again. And then in the end, it goes down for the third leg. However, the thing is that this previous low is a very strong support. So for the third leg down, the probability won't be that high. So you should be cautious when you take the third leg down with the double top here. Reading the price action is very important as the market develops. In this example, we can see that here's a very strong downtrend because we have consecutive bear bars here. And then we have a double bottom here. However, the market is breaking the previous high here. And then we observe the market. So here we have an area here. We are having the higher highs here and also higher lows here. So at this moment, it's the same situation for the previous example, that at this moment, we are sure that the market is going to reverse. In this example, you can see that double top is the pattern for the day. However, there's so many bars between the 2 tops. If there's so many bars, that means the probability of the reversal will be lower, even though for this chart it goes down. We can also use the upper time frame here. It's the same that we used 15-minute chart here. It's clearer. However, you should be very cautious when you trade the double top here. In this example, you can see that we have a double bottom here. And then the thing is that this double bottom here is very choppy. It's not that clear. But it really doesn't matter. What we want to see is this top. And then it's breaking this top with very strong consecutive bull bars. That means there's a high probability that the reversal will go very high. So you can see that it's beyond the previous high here. In this example, we can see this is a double top. However, this reversal lag is choppy. So that means the reversal is very weak. That you can see that this market doesn't go much further for the reversal lag. In this example, we can see there's a double bottom here. However, this double bottom is part of the whole screen. It is not at the end of a trend, and it is not in the middle of a start of a trend. So that's why this double bottom here failed to going up even further. So you can see that the whole day is a trading range. In this example, we can see there is a double bottom here. However, one thing about this chart is that the previous downtrend has been going on for 6 hours. That's why when you trade the reversal pattern here, you're not expecting the market will go up much further. A lot of times when we see the double top and double bottom, we want to wait for other indicators to confirm the trend. Take a look at this example. So we have a double bottom here at a smaller scale. However, we have a trend line at the bottom here. These two bottom are on the same trend line. That increases the probability of this leg going up. And also here is another trend line at the top. So it's a breaking of the top trend line. So that's why the market goes up. Here's another example. we have the bottom trend line here, and then after we see this top, we can draw a trend line, and then the market goes up again to test this trend line again. So here forms another double top. So for this double top, you can choose to trade downward, and then the market can go down to test the bottom trend line. In this example, when the market goes down here, you can see that it's making a double bottom here. So you can trade the second higher low here. That is because we can see that here there is a level. It is a zone here, serves as the support and resistance, because previously here serves as the resistance, and then when it breaks upward, it serves as the support. When it touches the support for the second time, however, it failed. That means a strong buying pressure here. That's why you can enter at the top of this bull bar. In this example, you can see that we have a double bottom here. So another thing you should notice is that the double bottom is testing the previous day's low here. So this will increase the probability of the reversal. So you can trade confidently. In this example, you can see that we have a double bottom here, and then the market moves up. However, one thing for confirmation is that it is an event day. That means this bear bar with a very big tail at the bottom, that is because of an event. So most of the time, the event can serve as a confirmation if we don't have other indicators like the levels or the EMA. If you enjoyed my video, please don't forget to subscribe, like, and comment. You can also go to my channel for more videos. Thank you.